something that's really helped me in my career is writing. I'm such a believer that writing will help you produce more clear thinking. And the number one piece of advice that I give consistently to any founder is to write a deal memo on your business that is the ins and outs of why you're building this product, what the product does, and really the future of what you're trying to create.
Hey everybody, I'm Hannah Dittman, Operations and Finance host of the Startup CPG Podcast. Today I'm joined by Jaxon Stuart from Spacestation Investments. Jaxon rocketed from high school entrepreneur to CPG investor and now brings a blend of operator, finance, and venture experience with a healthy dose of heartfelt passion to Spacestation. Spacestation Investments sits at a unique intersection of venture, influencer marketing, and creator-led brands, born out of deep roots in YouTube, social media, and community building. They're not just writing checks, they're rolling up their sleeves as strategic investors to help launch brands into orbit. In this episode, we talk about how Spacestation approaches investing, SPVs versus deployable funds, their people, product, progress framework, and what really matters in choosing an investment partner you actually like as a human. We get into founder takeaways from companies like Graza and Magic Spoon, why every brand needs an always-ready Memo version of their business, and how founders should be thinking about AI in their strategy going forward. Jaxon keeps it tactical, candid, and very founder-friendly. Enjoy! Hey everybody, welcome back to the Startup CPG Podcast. This is Hannah, and today I am here with Jaxon Stuart, an investor from Spacestation Investments. Jaxon, welcome to the show.
Thank you, Hannah.
We're so excited to have you here today. I'd love to start out with you sharing a brief background of your personal experience and the path that led you to Spacestation.
Yeah, for sure. So I kind of have a unique path into venture. So as a kid, I'm a first generation college student, grew up in a small farm town, and saw a lot of my friends going to work at Sonic or McDonald's, making $7.25 an hour. And that just wasn't interesting to me. So I figured out entrepreneurship was a thing. Is you can go make money yourself, and started a car detailing business actually, just in my small hometown. Started with your mommy minivans, cleaning up baby vomit, French fries, all of that good stuff. But then quickly evolved into doing larger projects, working on Ferraris, working on RVs and boats, and even started hiring some of my friends and paid them 2x what they were making, all under the table. So yes, I started hiring a bunch of my friends, paying them more than they were making, at their jobs. And really just got this knack for entrepreneurship. And at the same time, started getting fascinated with investing kind of later in high school, just the concept of, the stock market and watching Wolf of Wall Street. I was just like, man, this is a really interesting world. So again, first generation college student, I go to the University of Utah. I'm based in Salt Lake City. So that was just the closest university to me. And it was really all I knew from going to the football games and everything else. And started studying finance, and it became more and more kind of entrenched and fascinated with that world, but still had this love and passion for entrepreneurship and this business I had started in high school that helped pay my way through college. So I really thought the perfect combination of entrepreneurship and finance was working in venture, because you get to work with a ton of great entrepreneurs. And in my case, with Spacestation Investments, I've honestly felt like a founder building out this really early stage investment arm of the proper space station, which I can talk about in a moment. But that's really been my path into venture. So just recently was promoted to partner, which is exciting, on the Spacestation Investments team, and have now been with the company, with the fund, for almost 5 years. So that's been my journey to Space Station, but maybe I can give you a little bit of the Space Station story, because we're a pretty unique investor, if that's cool.
Yeah, I'd love to go there next. Those are some really interesting canon events that you've had, and clearly shows that you've had a lot of hustle and passion and excitement for different things that I feel like it makes perfect sense that you ended up in investing. I'd love to dive into a bit more of the background of Spacestation Investments. Could you share kind of the context of the fund, your criteria stage, check size, AUM, all the nitty-gritty details, and the high-level overview of what you guys are doing?
Yeah, for sure. So I'll give you a little bit of the background story. So we were actually founded by a YouTuber of all things. So his name's Sean Duras on YouTube. And between his channel and his daughter's channel, they're doing 500 million views per month on YouTube, spinning off a ton of cash flow. And really, Sean McBride, the YouTuber, and then his business partner, Sean Holiday, took a lot of that cash flow and started building businesses underneath the Space Station umbrella. So Space Station Investments is really just the investment arm of the broader space station. And, we have obviously the two YouTube channels. We have an influencer marketing agency. We have an animation studio, an esports team, a CPG brokerage, and a bunch of other businesses. But really on the investments side, which is what I get to, work on every day, is, we started initially as like a corporate angel arm. We had, some excess cash on the balance sheet. And our very first investment was in Magic Spoon. So the high protein, better for you cereal based out of Brooklyn. We had one of our partners who invested and kind of introduced us to Gabby and Greg, the two co-founders there. And we're like, hey, you guys should for sure invest in Magic Spoon and then help them with influencer marketing. And the two co-founders, I hadn't joined the team at the time, but the two co-founders were like, yeah, let's do it. So they cut a small angel check into Magic Spoon's seed round, and they really went to work with trying to add value. They didn't know what the term value add investor was at the time, but cut their check and then immediately were like, what can we do to help? And kind of our claim to fame, and I have a little kind of show and tell here, is many of you have probably seen the Magic Spoon bowl and spoon. So this idea was actually incubated at the space station. So our managing partner, Tim Holiday, when we were seeding out product to a bunch of our network, which happens to be these YouTubers and influencers and other people like that, we're like, man, we need to send something a little bit with some pizzazz with this box of cereal. So we're like, oh, we can get dog bowls off of Alibaba and these neochrome spoons off of Alibaba, and then laser etch them with the Magic Spoon logo and our logo and ship them out to all of these creators on YouTube, TikTok, Instagram. And it's going to be kind of like this cool viral moment, maybe. And lo and behold, it was. And Gabby and Greg loved the idea so much, and it just kind of elevated the brand that they're like, can we take this and run with it? And they did way better with the silicone, bowl and spoon versus our dog bowl that we were using. But anyways, that was the first investment that Space Station had ever made. Space Station Investments didn't even exist. And it's really just since evolved into what it is today. So we started spinning up SPVs because we had enough people within our network wanting to invest in the companies that we were investing in. So that's about the time that I joined the team. Again, have a more kind of traditional venture finance background with a few other funds that I worked for. Was brought on to kind of help build out this syndicate model. So spinning up SPVs, investing deal by deal across the consumer landscape. So that was Oura Ring, Olipop, Slate Milk, Oats Overnight, Graza, a ton of CPG products, and then other kind of consumer product, health and wellness, and then some SaaS sprinkled in there. So we're consumer generalists. Really from the SPV side, we have so much flexibility. So we don't have kind of like minimums that we have to meet, maximums we have to meet. We can really just flex that SPV based on what the company needs, which has been really nice for us to build our track record that way. But the exciting thing is on October 31st of this year, we just had a first close on our formal venture fund. So now we're going to have two ways to support companies. One is going to be the SPVs. Those are going to live on. We still want to like bring deals, great consumer deals to our network of investors. But now we have this committed capital vehicle, and any founder that's worked with us, I think would have positive things to say. But I think the hard part has definitely been, we'll commit to invest, but we don't know what our check size is with an SPV. It's like, it could be 200K or it could be 6.5 million. So if you could give us that range, that'd be awesome.
A little small range.
Yeah, exactly. So now with the committed capital fund, we have a more strict thesis, investing pre-seed to Series A, cutting $250K to $2 million checks into companies, depending on conviction, stage, needs, and then really focused in that consumer world. So anything CPG, consumer product, consumer tech, or like your, call it e-commerce enablement or other B2B2C companies where we can make a ton of intros to the brands that we've invested in, especially if they help them with marketing or, selling on e-commerce or whatever else. That's all within our wheelhouse. So there's the space station story for you.
That's so interesting. You shared so many interesting nuggets. My brain is buzzing. I could go in a million different ways right now, but I just wanted to pause and take a second to explain SPV, and kind of double click on the concept for those maybe less familiar with it, and contextualize what that means for relevance and deal structuring and how the deal process might actually get done.
Yeah, for sure. So an SPV stands for special purpose vehicle. It's just a fancy name for an LLC. And really, this is how we invest deal by deal. So if we go out and find Oura Ring and we want to invest in Oura Ring, then we'll spin up an SPV. We'll go to our group and say, hey, we're investing in Oura Ring. We're really excited about it. What do you like? Do you want to join us, basically? And then people opt in or opt out. They choose their check size, and then we're off to the races. We have a close, and that vehicle has only one company in it. There's not a grouping of companies. It's just Oura Ring. So we spin up a unique SPV for every single deal that we do. Compared to the fund is where we're taking commitments up front, but the investors or the limited partners don't know what they're investing in. They're just trusting that the space station knows how to pick companies, to add value, and to generate great returns for investors. So it's a very different model. It's a lot more based on trust and track record of the GP or the actual person making the investments. So anyways, there's hopefully a helpful breakdown of the two.
Yeah, that's so helpful. And I think a great summary of it. Couldn't have done it better myself. And who's in your SPV network? What kind of profile are those investors? And would you classify them as kind of an angel investor network, or how do you like to think about your SPV investment partners?
Yeah, for sure. So, we're pretty unique in how we approach the SPVs. I mean, initially it's a lot of just people who have, call it the $2.5 to $5 million net worth. You've kind of maxed out what you can do in the public stock market, maxed out your 401k, have some real estate. And it's like, what else do I do with this, net worth? And it's like, well, you should invest in startups, especially ones that you are passionate about and, want to see become successful. So anyways, that's kind of like an initial grouping, but I think what makes Space Station unique, going back to our roots in the creator economy, having a founder who's a YouTuber and a top YouTuber at that, and just our network within the creator economy, from the influencer marketing agency and just all these different activations we run. We own and operate the largest conference focused on creators on YouTube, TikTok, Instagram, all of that, called Vid Summit. We're co-owners with Daryl Eves, Mr. Beast, Jimmy, and then Space Station. We're each a third partner. So we're just really plugged in on our thought leaders in the creator economy. So that's oftentimes what we're adding value to our portfolio companies on day one. We're bringing in, if you're a prenatal supplement company, one of our strongest categories on the agency side is mommy bloggers. And that, I think, really resonates with that type of product. So we don't focus on forcing our companies to work with our agency or forcing our companies to do anything within the other businesses that the space station has. It's completely opt-in, and you get special rates and lower minimums and stuff like that. They operate their own businesses. But what we found is founders are stoked when you can have a mommy blogger or other strategic investor that really resonates with your brand investing in your company, joining your cap table, because now they're incentivized to talk about your brand and product because they've seen it, lived it, loved it. And I think that differentiates us a little bit from other maybe celebrity or influencer backed funds. We're not focused on bringing like really strategic people into our fund. We want like your family office, the people that you just don't know that have a lot of money in the fund. And on the SPV side, we're hyper curating who that grouping of people are to invest in these particular companies. So like to go back to the prenatal supplement example, if you have a fund that LeBron James is invested in and that fund invests in that prenatal supplement company, what is LeBron James going to do for them? Probably not much. But if you bring on Space Station, we'll invest out of our fund and then we'll spin up an SPV and we bring in, women athletes and mommy bloggers and other people that would really resonate with your product and brand and be able to help push it. Like, we think that's kind of our unique model. So.
Yeah, a hugely unique value proposition and a really interesting way to approach the investing side, a very modern approach that I think is very relevant for the consumer behavior landscape of today, and how people are learning about things and shopping and operating. And I think that's really cool and really unique. So I can see why you guys have so many great logos already racked up in your portfolio. I'd love to kind of look into the diligence process a little bit next. Obviously, I think as founders listen to this, I'm sure they're hearing all the like starry-eyed amazing things and seeing all the potential they could have for their own brands. Um, but what are you guys really looking for as you're evaluating companies, and what is standing out to you in kind of the diligence process, and how does that process work specifically for you all?
Yeah, so we focus on three things, and we call it the three Ps, and trying to get creative there, I guess. So it's progress, product, and people. So and that's kind of in reverse order of what's most important. So number one is people. I think most early stage VCs will say that. Who is the founder behind the product? And that's really who you're betting on. And then, yeah, we like to look at both product and is it differentiated in the market? Do we like the product? Like that's oftentimes how we make investments is we're pretty, early and innovative on a lot of the products that we're using and consuming. Kind of a funny tangent is that's how I found Spacestation Investments is I was an early Oura Ring user. You can see it on my finger here. And I was just looking like, yeah, I wonder who's invested in Oura Ring. And I found this company up in Layton, Utah, of all places, that invested in one of what I thought at the time was and still is, one of the coolest like consumer health companies out there. And I'm just like, no way, there's someone right in my backyard that knows Aura. And I reached out cold on LinkedIn to basically just say like, hey, you invested in Oura Ring, Olipop, Magic Spoon. Like these are so cool. Like I'm customers of all of these. Can we talk? And yeah, anyway, so that's kind of getting away from the point. But really, we just like to invest in companies that we would be a customer of, or we can clearly validate that there is a clear use case for this. It's not just a better brand, a better marketing approach, but like there's actual innovation and a moat around the product. So yeah, as far as like maybe like some takeaways for a founder as a VC is doing diligence, I think one of the key things, like if you were to draw a thread across our portfolio of what makes us decide to invest in a company, because most VCs say no 99% of the time and say yes that 1%. So how do you become that 1%? It's really just around momentum, and that could be a myriad of things. It's momentum behind the brand, momentum behind growth, momentum in retail, momentum behind traction actually building the product. I'll give you one example. You can see probably over my shoulder, Graza. So we're early investors in Graza, and I think they've done a phenomenal job at building that business. But when we initially invested, they were 6 months post launch, so there wasn't a ton of data to look at. But what we were finding is there was so much PR around the brand. For some reason, they had just really taken, the PR world by storm. They were getting articles in the New Yorker, New York Times. It's like, this is like a 6-month-old startup that just launched. They had just started going into retail and started seeing great velocities there. But again, not enough to say like, oh, this is an obvious win. But we saw enough of those boxes checked that it's like, there's a lot of momentum coming behind this brand. And that's what really pushed us to invest. So it wasn't anything individual. It wasn't revenue traction. It wasn't PR. It wasn't the social listening that we were doing. It was all of the things. And it's like, man, this is interesting. Let's go.
Yeah, it's kind of like popcorn. You're looking for the anticipation of when the kernel is about to pop and kind of be along for that journey. I think that's a really interesting example with Graza as well. And kudos to them. I love the Graza team. I think they're doing a phenomenal job. You mentioned people as the primary kind of evaluation bucket, a higher priority evaluation bucket. What are some of the traits of exceptional founders specifically in your portfolio that you work with and that you like to see in companies you're diligencing?
Yeah, I don't think that we have necessarily like a specific thing that we're looking for in founders. Like there's a lot of the obvious stuff like grittiness, hardworking. Do you have background in the space? All of those, like, I think are just table stakes at this point, but we really just like to get to know the founder. And, when you look at like a stat that I recently heard that kind of blew my mind is the average, marriage in the US lasts like 9.5 years. And, oftentimes like you're investing in a company sometimes for 10, 12, 15, 17, 20 years. And it's like you are signing on to a very long-term relationship with the person, that you're taking money from as the founder, but also as an investor. It's like you're, going to be spending time with this team and supporting them through, a lot of ups and downs. So it's like, do we just enjoy spending time with that person? Is one of our biggest diligence criteria. And yeah, like it's just time spent. It's not anything special test that you have to complete. It's, us flying out to meet with you. It's us getting on a ton of Zoom calls and talking about things that aren't related to the business. Yeah, like that's all interesting to us, so that we can actually get to know who the human is behind the company that we're hopefully investing in.
I love the human approach, and I think it's really important. And given how many hours everyone spends at work, with your stat, I feel like it might even be that you end up spending more time with a company, like hours wise too, than even in a marriage. So important. And I think, there's a lot of hard judgment calls that need to be made in businesses. And I think who someone is as a human dictates a lot of the decision making and leadership that they have. So I understand why that's so important. Reversing the question now, why do you think you're a strong fit for founders, and what do you think a founder should be looking for in an investment partner as they're thinking about their side of the equation?
The partners on our team, like, were founders first, and then, built and bombed a couple companies, built and sold a company. I'm more of like the, kind of born and bred investor. But, even, from building Spacestation Investments, like there's been really, really scrappy times and hard decisions building this investment group from the ground up. I mentioned like, we just had a first close on our venture fund, which is actually allowing us to like have a consistent paycheck. But all the SPVs, like, we never know when we're going to be making money. And it's like, we have to go out and kind of eat what we kill, which was, yeah, a scary, like, startup like experience for us. And we're finally getting into that. I just told someone today that it feels like we just raised a monster Series A from like L Catterton with this fund. So
I get what you're saying. And for everyone who's maybe needs a little bit more context here, when a fund raises from LPs, they get management fees, which is a percentage of the amount of money of capital that they've been given to deploy. And so that's where the salaries come from, and the office expenses and all these other things. But in an SPV, I assume you're not getting those management fees, or maybe only when the deal gets done, or if depending on the volume of what the SPV ended up being, a percentage of that. So a lot less predictable and maybe a lot less recurring, maybe not on an annual basis. So yeah, definitely, I am sure a lot of founders resonate with that feeling.
yeah, for sure. So like that's I guess my way of saying it's like we've been there, we get it. Like, all we want to do is focus on, our most important side of the business, which is meeting with founders and investing in great companies. And when you have to go, spend time on fundraising or figure out how healthcare works or whatever else, it's like those are just kind of like the necessary evils of the business. So yeah, it's like I think that we just resonate a lot with founders in that journey. So like, we try not to be jerks and don't request like just busy work of a founder to like waste their time on. And I've really just found like being a good investor is a pretty low bar. It's sad for me to say that, but it's a really low bar. It's like, if you can make some intros, not annoy people, be helpful where you can, and like you're probably like a top 25% on a founder's cap table. All the stuff I talked about previously, like the influencer work and, working with the CPG brokerage, Space Station CPG, on our side, and access to these two YouTubers that do 500 million views per month, especially if you're in the, kind of kids and family ecosystem. It's like those are, that's all of their content is on YouTube Kids. So anyways, there's all of those pieces that I think are the obvious ways that we add value. So yeah, I've already touched on those, so we don't need to go too in depth.
Yeah, I think it is sad but true that I think so much empathy can be lacking in the investment dynamic, because in some ways the power dynamics are just so lopsided at times that it kind of sets the stage for that to be the way the relationship can be set up. And yeah, I agree. I'm glad I think the industry is kind of changing a little bit as people are getting a little bit more broadly focused on CPG. Once again, there's a little bit more, not a ton, but a little bit more competition on the investor side, which always is like good to drive companies forward. And yeah, I think it definitely makes you stand out. The empathy that you have, the understanding, and the general human approach to business is so important, and definitely something that I feel sets you and your firm apart. Um, I'd love to take a second, given that you've had such a broad swath of experiences and you guys move quickly and have seen so many things, reflecting on your career and investments you've made. I'd love to know some lessons learned or compelling anecdotes that you think other people listening could be learning from.
Something that's really helped me in my career is writing. I'm such a believer that writing will help you produce more clear thinking. And the like number one piece of advice that I give consistently to any founder is to write a deal memo on your business that is like the ins and outs of why you're building this product, what the product does, and really like the future of what you're trying to create. Not only is that helpful for investment discussions, because most investors I know are writing a deal memo and doing market research and validating all of the things that the founder's telling them. So you're going to be more successful in fundraising. You're going to be more successful onboarding great people into your team and getting them immediately up to speed on the vision, the product, how you operate, everything. Even though it just takes time to take what's up here and actually put it on a page in a way that someone can, understand and pick up and run with. It's hard. It's not easy to do that. And it's not just something that you can digest, with ChatGPT or something. Like, it definitely takes effort. ChatGPT can be a great resource, but I think at the end of the day, it's your, clarity of thought going pen to paper that, will really help. So that's really the number one piece of advice I give to founders, and is something that I've learned in my own career. So.
Yeah, I think that's a great piece of advice, and a really unique way to think about things. And it is true on the investing side. You have your diligence decks. I mean, you could be having like 100, 200 slides, so much data, all this stuff, and you still will be writing a written essay-like investment memo version of it for your LPs and for your IC. So I do think that is a completely different way of thinking, because it's distilling down just a universe of information that you have into a different format, and it really makes you think through how you want to articulate strategy and double click on a couple of things too. For people less familiar with a deal memo, could you give a brief overview of what it kind of contains, how long it is, what it is like, what the things they should be thinking about writing about are?
Yeah, yeah. I mean, from the investor standpoint, like in my early days as like a hardcore analyst at, a growth fund, like they were 60 to 120 page deal memos, and they were so chock full of information. I now prefer to write a little bit more kind of narrative style, still very data driven and, bullet point driven, but prefer the narrative style because it's easier for someone to kind of pick up and kind of follow along the story. So yeah, like as far as what to write about, a VC is going to write about every single aspect of your business. Like literally everything that you think of on a day-to-day basis, a VC is going to be writing about. So it's what market you're playing in, the traction, the contracts that you have, and what's coming down the pipeline. It's what makes your product differentiated. It's the supply chain for your product. It's how is it being impacted by tariffs? That's a new conversation. So that's a new line item in our deal memos now. It's how is AI playing into your business? Even if you're not a native technology company, like I think it's kind of obvious, like we all need to start leveraging AI in order to kind of keep up with everything going on. So yeah, like it's everything that you're making a decision about as a founder can go into a deal memo, and it can again be that living, breathing document where not even just for investment conversations, but when you're onboarding someone new into the team, it's like they can immediately go to the AI section and understand, oh, this is our AI strategy and this is what we're trying to accomplish. And now I'm aligned on that mission and goal, and can, in my role in supply chain or marketing, can be able to look out for interesting tools for us to leverage. Anyways, so I could go on, but it's every aspect of your business you could write at least a paragraph about, And sometimes it's going to be 10 plus pages about your product and the intricacies of it and, how it differs from the competitors. And again, it's this living document where if a competitor releases a new feature or a new SKU, like you should write about that. You should update it. And it's like, what are they doing differently than us? And does that put us at risk? Are we still differentiated? What do we need to do with our own product development cycle? Do we need to do nothing because we're not trying to chase, trends or anything? Like all of those are decisions that founders are constantly making. But I think, again, just putting pen to paper or, finger to keyboard is, the right way to go in terms of actually distilling that information and developing more clear thinking.
Yeah, and it helps keep things out of a brain trust because, like you're saying, I think founders are definitely, I mean, I'm sure every founder is going to bed at night with all of this streaming through their mind. But it helps disseminate. And I think the quicker you're growing and the more quickly the world changes around you too, the more other hand and knowledge sharing needs to happen a little bit more real time. So great advice. And I'm sure your portfolio companies probably has some like best in class operational excellence going on with that North Star standard. I'd love to take a second to touch on some thought leadership. You guys are looking at so many different things and seeing a lot of interesting concepts. You seem to be very creative, forward-thinking investors as well. Are there any current consumer trends or categories of interest for you all that you've been spending a lot of time thinking about lately?
Yeah, I feel like, health and wellness is like eating the legacy incumbent, CPG's lunch right now. There's like the better for you version of everything. And that's been a pretty consistent thread in our portfolio. So like, I wouldn't say like we're oftentimes, chasing different trends, intentionally. It's oftentimes based on like where we see a lot of consumption happening and where we see like actual lasting change happening, not just, a trendy product or whatever else. Something that, we're starting to integrate a little bit more and seeing trends within our portfolio companies is more on the ops side. So let's assume you check the box, great founder, great product, great progress. We're almost going to add like a fourth bucket there. That's just operations. And that's really kind of AI driven of how are you leveraging AI in your organization to help with efficiency, efficacy of anything, supply chain, marketing, hiring. There's so many different tools that people are creating, AI for. And we have one example in our portfolio, and I'll leave their name out. This is like a large business now, 300 plus million in revenue. And we were on kind of their update call at the beginning of 2025. And for 2025, they'd approved 70 headcount to be hired into the business. They were growing 50% year over year expected for 2025. So by no means were they slowing down on growth or anything else, but they reduced that 70 approved headcount down to 4 because they have an incredible CTO who has started building internal AI tools that, are reducing the need to hire and also reducing like other kind of software spend. Like Amazon's a great example of this, where they don't pay for Zoom. They developed Chime internally. They're developing their own tools because it's like, why would you pay Zoom $1 million a year, probably $10 million a year plus, to do something that we can just whip up overnight kind of thing. So yeah, we're now that the development cycle has just rapidly increased in terms of speed and quality. I feel like even if you're not a technology or, AI native company, like you can leverage best in class tools that are being built specifically for your business in e-commerce or in retail to really become a very efficient and lean business, which is going to make an investor stoked, where you're not, bloating your operating model with a ton of hiring. You can really focus on like, who am I going to hire that's going to move the needle? And how can I leverage best in class AI tools to, help on the operating model? So that's kind of quick thoughts there.
Yeah, I totally agree. And I think it's very top of mind and of the moment for a lot of people. Even myself as a solo founder, we had like a issue with our website, and I was like, I'm sure AI can help me fix this. Like, I've never coded before in my life, but I was able to just solve our website issue and have ChatGPT figure out the code for me. And yeah, fix it in a matter of hours instead of needing to go find a developer, pay them thousands of dollars, not understand fully what was going on anyway, yeah, it's a different world we're living in. And I feel like it's a great resource, especially for early stage startups that just don't have the capital, don't have the time, have a million things going on. So definitely echo that. Um, I'd love to hop into a case study question now. As you know, Startup CPG has the largest Slack community in the industry with now over 30,000 members. I'd love to pull a question directly from our channel and have you answer it as a case study for any founders with a similar question. The recent question was, how do I know when to start fundraising?
Yeah, so I think that there's 100 different reasons of, why you would start fundraising, but I'll give you one really recent example within our portfolio. So this is a business, again, we'll leave the name, kind of quiet, but this is a business that doing 30 million in revenue, nice size business, and are profitable. So they don't need to raise more money, and they've been profitable for over a year now. So like we're stoked as an investor. It's like, hey, I feel like that's every founder's goal is like reach profitability, and they're growing, 20 to 30% year over year, which is great growth. So like we're not upset by any means about the company, but yeah, I think like with founders and with investors, like you need to make that decision. One, when you're going to bring on capital, if you're going to bring on a venture investor, it's like you need to be ready one day for the exit. Like there's no kind of lifestyle business here unless you plan on buying out the cap table so it can be a lifestyle business where it's just you as the owner. Then yeah, it's kind of misaligned incentives because venture makes money by selling companies. So with this particular company, they're opportunistically raising a pretty large growth round. Again, profitable business, still growing, have built out a great team and keep doing that for another 10 years. But we engaged with bankers, and those bankers like basically walked us through the M&A landscape and said like, hey, like you're really not going to start being in the eyes of an acquirer until you hit XYZ, figure of revenue, EBITDA, and then net income. So we're like, okay, how do we get to that goal? And we're going to get there in 5 years, but maybe we could raise a growth round and get there in 2 years and then, exit in 2 years. Like that's exciting for us. So we worked with the founder to basically put together a really interesting deal, both for the company and for the investor. That is all the money that they're raising is being poured into growth to accelerate that exit timeframe. And I've already engaged in bankers. So I give you that example because there was a very clear reason why we're raising capital with a clear outcome of what that capital is going to do. And I think if you're just blindly raising of like, I think I need $2 million to make my dream come true of creating this product, that's not good enough for an investor. It's like they really want to see like, what is the outcome of this raise? And where does it get you? It doesn't always have to come true. It's like startup land is wild. And oftentimes when we look at pro formas that founders are putting together, it's like we won't even look at it because it's probably not going to become true. It's either going to be way better or way worse. But very rarely is a pre-seed seed stage company right on their pro forma model. We have a few examples where the founder is just maniacal on data and like is, I swear, like a Wall Street analyst with how they report to investors. And it's like, wow, you missed revenue by $2. Like, good for you.
That's insane. Good for them. They need to go hit Vegas.
Funny enough, so I think it's okay that I talk about this. So the founder I'm referencing is Brian Tate with Oats Overnight. And what's funny is his background before he started Oats Overnight was a professional poker player. So your Vegas comment was spot on.
Yeah, it gave me that vibes because, even investors can't forecast that well typically to that level of accuracy. That's awesome. Well, before we wrap up, I want to take a second to make sure our audience can have an actionable next step to apply all of this amazing knowledge to. Thank you so much for sharing so many interesting anecdotes and having such a candid, fun conversation, Jaxon. For founders that want to get in touch with you, where can they find you, or what is the best way for them to get in contact? And for anyone looking to transition into investing or working with you all, what advice would you have for them on the investing side?
Yeah. So founders can reach out on our website. You can also find me on LinkedIn. Reach out there. I'm pretty active on responding to DMs. And then, as far as, investors who want to get into it, I think the best thing that you can start doing if you want to become a venture capitalist is to start talking to founders, start networking, and start being value additive to the firms. Like I've had multiple people who want to work for Space Station Investments go out and source really interesting consumer deals. And then when they reach out to me, they're like, hey, I have this really interesting deal, would love to talk you through it. And then on the back end, they're like, by the way, I'm also looking for an analyst role, at a firm like yours. And I think if you just start adding value to GPs, early, like you get noticed versus just, kind of random cold outreach. So that's for investors. And then for anyone who is currently an investor and looking to deploy into consumer startups, we have the SPVs, we have the fund. So if that's interesting, again, same channel as LinkedIn or on the website, always down to talk with, any folks who want to invest in great companies like Olipop, Graza, Oura Ring, so on and so forth.
Well, thank you so much for all of your time today. I really enjoyed our chat, and I'm sure our listeners will have a lot of interesting nuggets that they've taken away from it. So I appreciate your time, and thanks again. It was lovely chatting and learning from you.
Right back at you, Hannah. Thank you.
Awesome. Thanks so much for tuning in, everyone. If you like this episode, show us some love with a 5-star review at ratethispodcast.com/startupcpg. I'm Hannah Dittman, podcast host and correspondent here at Startup CPG. I hope you'll join me again as we dig into more juicy topics like ops, finance, and all the real talk founders actually need. Come say hi on LinkedIn or ping me on Slack. I'm always eager to hear your questions or brainstorm future episode ideas. If you're a potential sponsor and want to get in on the fun and appear on the podcast, shoot us an email at partnerships@startupcpg.com. And last but not least, if you haven't already, don't miss out on our free Slack community for emerging brands and CPG lovers alike. Join us at startupcpg.com. We'd love to have you. See you next time.